Hello, I'm Bill Hettinger, and this video in our Living and Working Paradise series focuses on resort community housing economics. The classic economic model teaches us that supply will adjust to equal demand. So if the supply of housing gets out of balance with the demand, the suppliers of housing will adjust and make more housing available. But there's this reality we see in a resort community where supply does not adjust to equal demand. There is these external factors, externalities as economists call them, that affect the supply of housing in the resort community and affect the demand for housing. We have land use regulations, we have this retiree and second home buyer externality, and we have natural barriers. Let's take a look at each of these. There's a desire to keep paradise unique. We want to keep it attractive, we want to preserve the environment, we want to maintain that picture postcard image of paradise. We create zoning regulations, land use regulations, growth management regulations, environmental regulations. These regulations define where housing can be built, define minimum lot sizes, maximum height restrictions, the number of units per acre, how close to the beach you can build. They address water and sanitation concerns. They address traffic concerns. In coastal communities, they may address hurricane evacuation concerns. And we also at times regulate the views of your neighbors from your neighbor's property such that you can't create a tall building next to a short building that impedes upon my view of paradise. So these regulations have the effect of limiting the number of houses that can be constructed. So builders focus on supplying the larger, more expensive houses where the money is, and they're not able to supply the smaller, more affordable units. They're basically not able to pass the costs of the regulations onto the housing prices and sell them at affordable prices. Now, the second externality in a resort community is a retiree and second home market. So we have this demographic feature. Baby boomers are aging. They have significant wealth as a group, and the U.S. tax code currently treats real estate very favorably. Additionally, the U.S. is a preferred location for foreign investors. So not only do we have baby boomers looking to retire and purchase in paradise markets, we have foreign investors looking to do the same thing. And real estate is an alternative investment to stocks and bonds. So real estate is also treated as an investment opportunity. And resort communities are a favored place for this investment because not only can you live in a house, but you have the opportunity for a return on your investment. So let's look at the second home externality in a little bit more detail. The buyer's wealth with the second home externality, the buyer's wealth is derived from another place. Typically a much wealthier place. It's derived from the city, it's derived from New York, it's derived from Washington, D.C., it's derived from Miami, it's derived from Los Angeles. It's not derived from the local economy. So homes that appear to be expensive to the locals appear to be very inexpensive to the second home buyer. So what we have the effect of is the home prices in resort community are set by an out-of-town economy. So homes are sold to retirees and as second homes, and these homes are no longer available to the local workforce. So what are the economic effects? Well, this decreases the supply of resident housing. It also brings a different type of resident to the community. They're part-time residents. They're not there all the time. They're not necessarily involved in the community. They're not serving on your civic boards. They're not running for mayor. They're not running for town council. They're part-time residents. Additionally, they're not purchasing high-value services locally. Their lawyer is still in their home location. Their financial services are purchased in their home location. Their doctor is in their home location. Instead, they're creating service jobs in the local economy. There's real estate services to keep the properties occupied and keep the properties maintained and repaired when the residents are not in those properties. And second homeowners, being wealthier, tend to contract out the work for maintenance and repair rather than do it themselves. So it's changed your market dynamics. So they're not looking at high-value services, they're looking at sort of low-value maintenance, repair, real estate services. And then the final externality for resort communities are the natural barriers. Paradise is a landlocked place. It's bounded by water. It's bounded by mountains. It's an environmentally sensitive place. And this basically means there's limited land available for everything, But specifically, there's limited land available for housing. So what does this lead us to? The housing market in the resort community fails. Supply and demand become out of balance. Regulations and natural barriers limit the supply. Retirees and second home buyers increase the local demand. The locals wind up outbid for housing by wealthier buyers from an external economy. The market is not functioning properly. So what's the impact? Well, local residents become displaced. The workers commute from further away, so all of a sudden you have additional traffic issues, you have additional parking problems. The local economy suffers from a lack of workers. Workers leave. You can't bring new workers in because they can't afford to live locally. And finally, the quality of life in the community declines. Families live elsewhere. Civic participation declines. It becomes difficult to find people to run for office or serve on civic commissions. The economic vitality of a diverse community is lost, and the community basically becomes dedicated to servicing second homeowners. This concludes the Living and Working in Paradise video on resort community housing market economics. For more information, please be sure to contact us at Prosperous Communities. That's www.prosperouscommunities.com.